introduce this panel, and it's really exciting what Link2 is doing for liquidity and private equity investing. And we want to keep expanding the liquidity in private markets. So on that note, how do we prevent times of irrational exuberance or heightened FOMO occurring again and again? We know the expression that a rising tide lifts all boats, and its counterpart, when the tide goes out, you find out who was swimming naked. So here are two panelists I'm thrilled to introduce who will speak to that embarrassing moment when investors get caught naked in the low tide. Sara Ledterman is a venture capitalist, a serial founder, a female founder advocate, part of Women in Blockchain, and a tech advocate. She is managing partner at 3+ Ventures, the first non-accredited investor fund to open access to venture for all. She's currently focused on investing in female-led teams and is dedicated to changing the landscape of venture funding for a more equitable future for people and planet. And joining Sara is the equally impressive Kandice Cota. Kandice is a serial entrepreneur, venture capitalist, design leader, founder, and noted member of Women in VC. Kandice is currently with Trac VC. She was one of the first 10 VCs at Intel's venture fund, Intel Capital, and has been working with some of the biggest brands across many industries. In FinTech, she's helped PayPal and Morgan Stanley. She's worked with Target and Macy's in e-commerce. She's worked in entertainment, working with CBS, NBC, MGM, and Oxygen, and Samsung and Hyundai in mobility and in travel with Hyatt. She brings research and design leadership to product design teams and innovation strategy to the C-suite. In her current role, she's leading design for Trac VC's unicorn platform while helping to shape the fund's portfolio. And she passionately combines design strategy, hybrid research, analytics with product planning expertise to elevate the craft of products, campaigns, and platforms. She is known for invigorating legacy and startup brands both. And I know Karim is excited to moderate this panel and talk about his new phrase, dynamic diligence.
Shelley, I need to ask a favor of you. Before I come on next, can you make an intro for me? That is beautiful.
Yes. Oh, well, Karim, everyone knows Karim.
Yeah, but so much depth. Kandice, Sara, thank you, Shelley, for making the introduction. Kandice and Sara, thank you so much for being here, allowing us to. We have a challenge going on by some of our speakers, some of our attendees, and what they want us to do is unpack as many times as we can, because then we're filling a jar with $5 bills for everyone who says that. So let's unpack what we're starting to do. And basically the phrase that we're talking about is, what are you wearing when the tide goes out? Shelley leaned towards being naked. It could be anything or nothing. But when we talk about something like that, what goes through your mind? I'll start with Sara, and then Kandice can jump in.
I think I would liken it more to the Emperor's New Clothes. You know, it's like everyone's like, yeah, they did diligence. Of course they did diligence. And then really, you know, nobody wants to say like nobody did diligence. So I think that's where we've seen this like major shift, is that people were in this FOMO mode of like, well, someone's already done it, so I'm just gonna jump on this deal, and not really like thinking for themselves. And so now it's like, oh wow, like I'm responsible for the funds that I put into this. Right. I'm responsible to my LPs. Like I'm a steward of this other person's capital. So I think it's going to be back to basics, where funds are really going to have to do their own work, like regardless of who else is investing, because now we learned it doesn't mean anything for Sequoia to be in and around, right? Because clearly they didn't do any due diligence. So it's like, I feel like it's gone back to every man for themselves. So you're kind of responsible for your own assets. And I think that that's where, you know, if we're going to put everybody's in a rowboat now, nobody gets to hop on the cruise ship anymore. if we want to keep with these ocean terms. So yeah, everybody's gotta, row their own boat now. And I think it's gonna be interesting for those who, say they don't lead and really are leaning on others to do the heavy lifting. It's not gonna work anymore.
Yeah, and I think that the big difficulty is, we'll keep in the ocean terms, is that due diligence is effectively dropping anchor for a moment, and nobody wants to drop anchor in a big wave. It's like we want to keep the wave rolling, the sway, and that's part of. It's interesting because a lot of the sort of rebellion and evolution around crypto has been around the regulation and all those things that keep in other people's money, OPM, a little more safe. And so I think that there's kind of a pullback, and now it's like, hey, we need to actually drop anchor for a few minutes and look at due diligence in the same way we would with anything else in life. We could metaphorically liken it to, doesn't matter if you're buying a house or you're trying to get a wife or a husband or look at a college, all of these things. It's interesting, I think, when the hyper excitement and the sway, overcome rationality. And so just, getting toward the sand of rationality, I think, is how we're proceeding now.
So I want to put this a little bit in context. There's been obviously plenty of news, plenty of drama around FTX and Sam. I call him Sam not just because Nose is my friend, but it's just like, it's easy to say Sam. But if we look at that case as an instant, very fresh in everybody's mind, in your opinion, Kandice, what happened and what went wrong?
So I think it's interesting because I founded a game company a little while back, and gaming is, when I was at Intel, gaming was one of the top tech industries that was pushing the advancement of the chip and the evolution of all platforms. And so from that, analytics platforms developed. And then, those were starting to be applied to other industries. And so that's where, these KPIs in technology measurement really came from initially. And all those protocols were just sort of thrown out the window in a way for crypto. And I think a lot of it had to do with, well, there's a segment of people that know a lot more about this than I do. And people sort of went against their initial thesis of investing in things they know. And so people started investing in things they really didn't know about. And I think that's really where, the hyper excitement and sway and the wave caught them off guard. And so but one of the points of back to basics is really understanding the economy of what you're investing in.
Thank you. So we go to Sara. Some investors, early stage, mid stage investors, talk about the theory of catching the wave. And so are you catching the wave on the way down? Are you catching it on the way up? And Bill Ty is one of those guys who talks about being at the right place at the right time, catching the wave. If we hadn't followed the hype that was happening with FTX and didn't invest because we didn't know enough, and clearly a lot of us didn't know enough, could we have missed that wave or caught it at a different time? How would you assess that?
Well, look, I mean, we're early stage investors, so there's not a lot sometimes that we can do other than really understand if we trust the team. So the earliest red flags for that team is that they didn't want to share anything they were doing. So it would have been out for us just based on the team. But then like there were so many things that didn't happen. Like you had late stage investors, like Series C investors taking their word, you know, and throwing out what they would typically do for diligence at that phase, you know, a true financial audit, you know, like, and they're like, oh, it's Web3, it's new, it's not new. It's like, they were a crypto trading platform. So you could follow any of the due diligence that you would do on a TradFi trading platform. Like, show me your tickets, show us your reserves, show us, you know, your P&L, like all of the things that you would do with a TradFi platform, you could have just done with FTX. Nothing's really different other than they're trading crypto, right? So if you have to like figure out where you're going to ride the wave, and you're like, oh, I'm catching this new trend. Well, you can easily apply, you know, what you know about relevant industries to a new trend and still make a somewhat educated guess. So I feel like there was a lot of like false marketing that's happening. And I don't understand if the VCs just didn't want to say, I don't understand this, but there's so much hype here, so I'm just going to trust someone else. But, you know, in the early days, there were a couple other companies. There was a big scandal a while ago with some of the universities that had invested in a specific company. And they assumed because Stanford was in, that Stanford had done the research, and Chapel Hill was in. So Stanford thought Chapel Hill did the research. And this kind of like bounced around, and they were trusting that the other players all knew more than them and had done it. And nobody wanted to be the person to say, I don't really understand what we're doing here. So they just wrote checks, and the whole thing was a fraud. So I think we're kind of in the same game where everyone wants into what they think is like the next gen of the web, or this next evolution of finance, but nobody's taking the time, to Candice's point, to really be someone who understands the space. Because if they understood the space, they would have known how to at least, you know, do some kind of diligence on this, or make like an educated decision about, you know, where they're at, and am I even getting in at the right time? Because if you looked at economic conditions, you would have said like crypto requires tons of liquidity, right? Because there's no utility right now, and there's no reserve. So the only thing it relies on is the public having capital to infuse it with. So if you're looking at the economy and you're like, we're 12 years out on a 10-year economic cycle, like we're probably going to be headed this way, is jumping in right now the right spot? Probably would have not been a good decision for, you know, for a later stage investor that's only looking at a 2-year horizon. You know, as a pre-seed investor, when you're looking at a 10-year horizon, you know, it doesn't really matter what market you get in on, right? But these are the things that I was wondering, like what was going through people's minds at the time. So I think it's really figuring out like where you invest in that horizon, and if like it fits that window and it's de-risked enough to fit that window. And I guess, you know, that this is like you have to take into account your risk factor, but I also think you really have to do your research. And one of the points that Candice has made that was so important is like, you know, stay in your own swim lane. like if you're a B2B SaaS investor, crypto trading platforms is probably not going to be your jam.
Yeah, and it's effectively like putting, you know, $1 billion of capital in an options market and doing a bunch of puts and shorts and not really knowing what the heck you're doing. And Sarah and I always like to make these metaphors, but I feel like it's the greatest game of musical chairs that ever lived. You know, it was like everybody wanted to play along, and then everybody's left without a chair to sit on because they thought it was, you know, they thought they would ride it longer and more in depth. But I think that the key is that there was a lot of market pressures too on on the big firms to get into the mix. And so I think at the risk of losing LPs, they wanted to get in the mix and you know, increase the potential spread. But to Sarah's point, the diligence wasn't there. But I think it's interesting because we find ourselves in this juxtaposition of sort of speed versus sort of accuracy. And like at Trac, we through our model, we're working on some of the, you know, the speed elements because we can through the platform, but there is diligence there. So diligence, whether it's being done by technology or people in my previous examples, or in person or research based, you know, there still has to be a model of diligence. And I think that this is going to really shape a different way of people starting to connect with investments and connect with almost like the fractional shares market, how that evolved. You know, people wanted to get in, not understanding and not being able to get into the bigger IPOs, et cetera. So, you know, fractional shares started evolving and giving people a piece of the pie with limited knowledge. So I think there's something, there's a model there that we've seen before from the stock market that is around, so, you know, something about regulation, something about analyst positions, and something about, you know, having consumers understand a little bit more.
So I actually do want to get a little bit into Trac and what you do specifically for that. But before we go there, I still want to go back to this trend thing that we're talking about. So if we look at FTX, it started, you know, it's 3 to 4 years. The time scale is very short, 3 to 4 years in which it started. It got traction very, very quickly. The valuations were out of the roof, and big time investors put a lot of money behind it, not understanding what they were doing and how the model works and what they were doing. So we've taken that as a given. A lot of the large VC companies have come back and said, hey, sorry, we made a mistake. But is there a fundamental question that we perhaps have to answer? So it's 2022 today, assuming that the time frame we're talking about is correct. It's 2019, 2018, when FTX started making all this hype and noise. But the market for investable opportunities from the B stage to 2018 for some of the technology companies was already exuberant. So if we take some of the diligence that was not done on FTX, was that actually just historical non-diligence that some of these large companies may have gone through during the preceding 4 to 5 years, and FTX were just caught on the back end? Sarah.
No, I think there was definitely a shift away from, you know, as timelines accelerated and there became like these more like escalating rounds that were happening faster and faster. I think that's when diligence started to slip, because it was really done previously well, but also a lot of these funds grew exponentially at that time, right? They raised record size funds, and they have to make, you know, a record amount of investments to make that happen, right? They can't sit on the capital. So like, as those teams grew, probably their procedures got sloppier too. And then there was this, like, you have to get in on this round right away. There was all this FOMO investing happening. So they were just cutting corners. And again, assuming, you know, someone else had done the work. And there's not a whole lot of VCs that lead rounds, right? There's a lot of people that pile on after someone's, you know, placed the bet, but there's not a lot of people doing that work in the first place. And so when those people got sloppy, then no one else is stepping in to do it. And I think it just was a downward spiral, but we saw it outside. I mean, look at Fast. They raised $100 million, and like were bankrupt in 18 months. Like nobody did diligence on them because that founder was like prosecuted in Canada for like extorting the government or something. Like there's just a lot of things that in a lot of different sectors that we saw that weren't done properly. And I think it ultimately comes back to you're a steward of someone else's money. Like you're holding the public's pension funds and you're holding, you know, people's retirements and endowments that are really important for, you know, programs nationally and internationally. Like you really are, you know, you can't just go buy a lottery ticket with that. Like you have to do some kind of, you know, de-risking of that. And that's why people use fund managers, right? If they just wanted to invest in anything, like they could do that on their own. They wouldn't need a fund manager and they wouldn't need to pay carry for that. So I think there's going to be a lot of swing back from LPs on accountability because there's a lot of markdowns right now. And there's going to have to be a lot of explaining. And it's not just in crypto. I mean, it's across the board.
Yeah. And I think it's interesting because at times we talk about the bro club. And I think this does come into play in the sense that if you've ever met any of the, and they primarily have been guys who have developed, you know, the algorithms and crypto models. I mean, you know, they fit a certain bill, and you meet one of them and they're extremely intelligent, so intelligent that you wouldn't think twice to second guess them. So, and they fit a certain age bracket, right? So as you walk into a fund like Sequoia, you're walking in through the analyst doors, and those analysts are coming from the same schools, Berkeley, Stanford, MIT, the same labs where these models were developed. And so it's like, yeah, that's my bro. That guy's like a genius. Okay, he gets in the door. Yeah, we need to get into crypto. We know how these meetings go. You have to sell the deal, right? And so you have the platform to sell the deal based on a lot of those factors. And it's why we have, you know, sway to begin with. So in terms of due diligence, I think there's a lot of sort of life lessons that a lot of the fund managers and partners can now really sit back and think about, because they a lot of times were riding on the coattails of the younger generation's hype.
So the Bro Club, I want to expand that a little bit and say, is it a Silicon Valley club? Because what the question becomes is, if you've got big VCs and where are the VCs based, do you find that there's a regional bias that once a Silicon Valley company invests in a company, then other funds will invest? Does that then transfer globally to say, hey, these guys are doing an investment in this company, and we should do the same because they're smarter, more educated, they're closer in touch with the company and the founders?
I mean, I think it you know, to Sarah's point earlier about the guy that came out of Stanford, I think, you know, people look to brands. We're very brand centric, and that goes with institutions, funds, et cetera. And, you know, people make bets based on those brands and the cred of those brands. So absolutely, I think that the Silicon Valley funds are the most, you know, they're the most accredited. They have the most sway in the global market. And so when you have one of those known funds in an investment, it's effectively like a security blanket. So I definitely think it does make a bigger impact. So it's puts more responsibility on those bigger funds, actually, just like it does if any celebrity has a bigger responsibility in the world to do right.
So I'm curious, as you are both actively involved within this area, have you seen conversations that are beginning to evolve by these large VCs and leaders in these companies that want to do things differently? Or how are they going to pay attention to the fallout that we've just seen?
I think they're being quiet and they're hoping that people forget. And I think they're dealing with probably a lot of blowback internally from their LPs. And so we're not hearing any apologies or any like, oh, we're going to do better. Or, oh, we want to change this, because they're just going to deny any responsibility in the ecosystem right now. But we see that. And I think that's one of the things that people would like to see change. It's like, there's a few key players that people are starting to believe are, toxic players. There was a statement by a partner at A16 that was like, oh, it's just a game of valuation over valuation, and then we get out, and it only sucks if you're left being the bag holder. Well, if that's how you're looking at investments, is that a fund that someone wants invested in their company? Probably not. Because then, if you're looking at it from that lens, then all their investments they're just trying to get in and get as high of a valuation as they can and get out before something happens. And if that's the type of investor that you have on your cap table as a founder, if you're trying to build a long-term sustainable company, like that person interests are not aligned with your interests. So I think founders are starting to also say, are these the people we want to do business with? And then other VCs are saying, well, they've left us out to dry. So do we really want to do business with them? So I think if they're going to want to stay, as anchors in the system, then they're going to have to change their behavior, probably not by their own choosing, but because it'll be required of them to participate, because people are going to start saying, I don't want to know a deal that they're on the cap table. And founders are going to start saying, we don't want them on our cap table. So that's going to become a problem.
Yeah. And I think that this also comes back to, really it comes back to the technology discussion of algorithms and AI and economic models, because at the end of the day, that's basically all it is. And so I find it interesting because, for instance, in AI, we talk about implicit and explicit factors in your models. And I think that, like, let's say, for instance, in a model, there would be, okay, if 10 million people put in X amount, then the model is going to increase by 20%. All of those modeling factors they're changeable, right? And they're modeled by data scientists. So we're effectively at, diligence means something a little different in the sense that it's almost about like, when you're doing those algorithms, does this model actually represent real life? Or does it represent a fantasy world? Which for a while it did. And everybody was like, yeah, I want to be in this fantasy world. It sounds great. But there's enough real life substance to it and liquidity enough to make people believe. So I think it comes back to those factors of looking a little bit deeper under the hood and understanding how a model can change based on different variables or different market conditions before it's really put out there for the public.
This is related to what you're doing at Tracking, right? The data input that goes back into your platform allows you to make dynamic decisions based on the inputs and the data that you're collecting on particular companies or funds.
Mm-hmm. Yeah, so it brings it brings much more of an agnostic POV to the investment decision. So that sway aspect isn't as strong. And it also has historical reference checks in there to sort of elevate and define the accuracy in the model. And I think that because when these new spaces evolve, the blockchain didn't necessarily, we looked at it just as a new thing. We didn't necessarily apply historical relevance to it. And I think that's where it sort of went. If we probably could have applied the internet boom, if, you know, some of the money modeling from actually after I was at Intel from 97 to 2003, we could have modeled that time around this and maybe made a few less bad investments in that respect. But yeah, I think that there was no sort of structural foundation there.
Sara, as you build and continue to fund companies, what are you, I mean, just tell us, I'm trying to understand if your model is similar, different. Are you using a platform, a back-end AI? How are you doing this diligence now for the folks that you're investing in?
So I mean, it's hard for our super early stage companies because there's not a lot there, but one of the things that we're building out for them and for us internally is a platform for them to plug in all their APIs. And so they can see like their burn like live. They can see, you know, what their sales pipeline looks like. Are they going to hit their KPIs? You know, we can see and they can see is, you know, the health of their company, but it also allow us to, you know, figure out how we price, you know, the company. And then also how they model out their valuation. So they understand too. It's like a lot of VC is very different than just building a company because, you know, you've got to hit certain KPIs to acquire more funding to grow to that next level. So it's understanding, are you like meeting your targets that are going to keep your company viable? Number one. But then for investors, we're really hands-on because we start early. So for us, we can go back and say like, hey, this pipeline does not match your, you know, projections. So, you know, what do you need to either increase, you know, the size of your top of funnel or start closing some of these deals that are like getting stale and don't seem to be moving across the finish line to like, hey, you went from 8 months of runway to 2 months of runway. Like what happened here? Or are you adjusting your, you know, your head count to meet, you know, product dev cycles? Like we can see and they can see. So hopefully, you know, early stage founders, sometimes we're taking a risk on them and they, you know, they're either technical or maybe they're sales oriented or maybe they're business oriented. But if they're not all three of those, like it's really hard for them to put some of these pieces together. So we're hoping to just, for transparency on our side, have them, but then also help them make better decisions for their growth. So we're changing the model a little bit. We feel like this will be better for everyone. It also kind of gives us live diligence into how companies are, you know, we don't have to hunt them down. We don't have to rely on them for accurate data now either. So it's really great. I mean, it's helpful to them and it's helpful to us. But we take a lot of time looking through some of these things, and we've been operators. So for us, it's a little different. We look at things from an operational level rather than, you know, just taking their word for it.
Yeah, that's actually, I think, a really key point in the difference of the funds that are successful today have a strong sense of operation and have a bunch of operators on the team. And that's something that, you know, just in a new evolution, it wasn't possible. It was new. But the same, you know, the operators weren't the ones making the decision. It was on the money side because, you know, they thought, oh, well, it's fintech. It's, you know, it's a money deal versus creating a company. So I think a lot of what happened had to do with just losing sight of operability of a company.
So this has really been fascinating, and we're getting very close. I mean, this conversation can continue for another hour without fail, but we're getting close to the time where we need to change panels. But I wanted to ask you, there are a couple of different things. So one, you're an investor, you're looking into companies, you're trying to do some bring up the term dynamic diligence to ensure that they're meeting their projected targets, and then make sure to keep them on track. And as operators, you can do that. Kandice, you mentioned a little bit earlier, you've got to worry about folks that have been indicted in different countries and have been bad players, and the visibility was not that clear of who you were dealing with. Flip that around a little bit and say, how do we do diligence on the funders or the companies that are funding these companies, right? So am I as a firm or a company looking for money, am I coming to Kandice and Sara says, hey, fund me, and I'm taking your check? How much clarity is it for the founders of these companies to do diligence on the companies funding them?
I say it's a marriage and your company is the baby. So you need to do as much diligence to make sure that you're happy being married to this person, and co-parenting your company with them, because once they're on the cap table, it's really hard to get rid of them. Mm-hmm. And so, it's your job as a founder to find out, where they are in their fund. Do they have another fund coming? Are they going to make those intros for you? Are they reserving, a certain amount for follow on, or, for bridge if you need it? That's really important in this cycle. I mean, there's a lot that founders do need to be a little bit responsible for. But again, like early stage founders don't really know. Series A and beyond, like, the game you're playing. Like, there's no excuses at that point. It's on you to figure out, who you want to work with. In. Yeah. But early stage, that's a little tougher.
As we look at what's happening in the market over the last 8 months, I think, with the meltdown in the valuations and the revaluation of companies, the reassessment of the industries that are making traction, like crypto, for example, a lot of hype, a lot of enthusiasm that now is, I think it's curbed a little bit. As we look into 2023, 2024, just a quick take on from Kandice, what you see, what as investors, what we should be looking out for, and the sectors, industries, and what you think of the general economic or investor environment over the next 2 years, and then followed by Sara as we wrap up this conversation.
Yeah, I think it's really interesting. It's funny because we always think of due diligence as, that's like the thing we don't want to talk about. It's boring, right? It's bureaucratic. But it's interesting because I think it's the inflection point or the intersection of where a lot of changes are going to happen between founders and funds and LPs. A lot of funds and players are developing tools and platforms to look at investments differently. Trac is one of them, in terms of figuring out how to select unicorns and help unicorns be guided on their way. But there's other models evolving around giving more LPs tools, et cetera. I think the fund market is going to change. The bigger funds are going to move toward more of a growth element and beneficial services in that way. And there's an evolution of individual LPs and smaller micro funds that are really going to lead the way in taking on most of the burden of the early stage. And so from that standpoint, you'll see, I think, a lot of companies joining together, forming collectives to help each other to really do the diligence together and share that on platforms, et cetera. So I think technology is going to play a different role now in the way that we've seen investment from the past into the future.
Sara, as you addressed that question, there was a question on the Q&A in terms of how we also evaluate the IP that companies have as we move down that path.
Actually, I think that's really important. And I just had a conversation. We were looking at a hardware agnostic robotics deep tech company. And it has some components that kind of fall into our thesis. And so what do? I know two people who are, MIT robotics, like one's a VC and one's a professor. And who am I going to call to diligence that? I'm going to call them. Like, I'm not going to rely on some analyst like digging through Google or just, saying like, this looks interesting, we're in. No, it's like, you're going to have to go back to the experts and really, align like where you want to focus, because some of these things are like, you're like, that's really cool, but that's not our area. And you're going to have to really step away. You're going to have to be more focused on thesis, or you're going to have to really rely on experts. And I think bigger than that, this is like what happened with, mortgage lending. Like to Kandice's point about there being more tech and tools, like we're seeing that when people are manually doing this and people are making those independent decisions and relying on some analyst, which is just, some, 22-year-old underwriter type of situation, like you're seeing the same problems now. So VC will have to change, and how we diligence will have to change in the same way the mortgage industry had to put a lot more protections and a lot more reporting and a lot more transparency, right? Because now VCs, the bigger question is how are you managing your portfolio? And there's going to be a lot more scrutiny of investment managers. And so to protect yourself, investment managers are also going to have to make sure their investment memos are done, that they've had, financial analysis done. They're going to have to protect themselves to keep their LPs. So that's also going to change.
Thank you so much. I really appreciate your feedback and candid responses. Looking forward to continuing to have you as we continue down this path of discovery and investment and understanding how this landscape is changing dynamically. And we want to make sure that all of us are paying attention to that. Sara, thank you so much. Kandice, thank you so much.